makes you so sick at heart that you can't take part. You can't even passively take part.
Yesterday, I made a video of the criticism of MMT, modern monetary theory, and it was a bit of a wonkish rant. And there were a few issues that I also wanted to discuss, but when I saw how long that video was, I didn't say it then. So I'm making this video as a bit of an addendum to some of that commentary and why this fits into the whole MMT debate. And this will be both in support of some of the ideas that MMT advocates promote, but also a bit of criticism. Like I said, I am agnostic about MMT, and I kind of want to do a bit more research before I take a definitive position on it. So, um, what I wanted to say in that previous video, but I didn't, was discuss a bit a different way to look at the economy. And this is known as the sectoral balances approach. Now, this is something that honestly, when I studied economics, I don't recall it being taught. Maybe it was and I just forgot about it. But I only got into it because I did quite a bit of research on Japan when I was working at Chatham House. This was shortly after the 2008-9 global financial crisis. And then I got into a bit of an interest in Japan because the Japanese Great Recession that happened in the 90s and 2000s had a lot of parallels with what would later happen with Western economies after the financial crisis. And I also read a really good book, which the title sounds a bit pretentious, but rest assured it is really, really good, about the Japanese crisis. It's called The Holy Grail of Macroeconomics by a guy called Richard Koo, which I strongly recommend it to people. It's probably a bit too dense if you have just a very, very layman's knowledge of economics, but it's also not too technical. So it's not like you need a degree to understand it. But I probably would not recommend it to someone who's just learning about economics. But if you're comfortable with like basic economic concepts and monetary concepts, I would totally recommend it, and you probably will understand most of it. So, what is the sectoral balances approach? When we think of the economy, we generally think of GDP. And GDP is basically a sum of different components in the economy. You generally have two ways of looking at it, and there's the demand side and then there's a supply side. The demand side of GDP usually is represented by private consumption, public consumption, that is what the government spends, gross fixed investment, so this is private sector investment, and then net trade. So that is, the difference between exports and imports of both goods and services. Then you have the supply side, which is based on more of an industrial view of GDP. So you have agriculture, you have industry, and you have services. But we tend to see these things as being kind of exogenous to each other. In other words, you can have a situation where investment, gross fixed investment stays flat, private consumption stays flat, but then government consumption skyrockets. And you will think, well, this is just the government being very irresponsible in its spending. But there's a different way of looking at this. Because we generally see government spending as the government putting money into, building highways, building roads, etc., or spending on social programs, etc., we tend to see it as, in a way, optional. And this, you'll hear this obviously with a lot of right-wingers and libertarians. The government should simply spend less. Except it's not that easy. And the sectoral balance approach is really useful in understanding why sometimes governments need to spend. So let's understand what this is. I'm going to show a chart in a bit, but first I'm going to explain the components of the economy in a sectoral balances approach. So, sectoral balances approach is basically looking at the economy kind of like an accountant would. So, basically, the different components of the sectoral balances must add up to zero. Okay, so we have four main components. Sometimes people just look at three. I'm going to explain why. So the first one is households. Now, typically households are the big savers of the economy. Now, those savings subsequently end up being deposited into banks, which then use that money to lend to corporations, which then invest that money. That is the standard view, and I'm going to criticize it afterwards. And if you saw my previous video, you'll probably know where that criticism is going to come from, but I'm not going to spoil it yet. So we have households, which tend to be net savers. Okay. Then we have corporations or businesses, however you want to call them. Corporations tend to be negative savers. That is, they invest more than what they save. So in a healthy economy, corporations tend to be spending more money than what they are saving. Okay. Then we have the government. Now, the government could be either a net saver if it's running a fiscal surplus, or it could be a or net negative saver, a net investor, if it's running deficits. So it could be either way. And then we have the final sector, which is what rounds out all the other ones, which is the rest of the world. So the rest of the world is interpreted as the current account balance of your economy. And the current account balance is usually seen as the difference between savings and investment of your economy as a whole. So what does this mean? How to understand this? Well, if you have a country that saves more than it invests, where's it going to put that money? It has to go somewhere in an open global economy. It has to go somewhere. So it ends up being lent abroad. And that basically is the situation of countries that are running a current account surplus. They're essentially being net lenders to the world. Countries that have a current account deficit are net borrowers from the world. That's the situation if your domestic economy, you had higher investment than savings. In other words, you need to fund those investments. And if you don't have any domestic sources of investment, you need to bring them from abroad. So you're a net borrower from the world. So that's how it all rounds out. So now let's look at how this looks in practice. And here is a chart from that book, The Holy Grail of Macroeconomics, because I think the Japanese example is incredibly useful to understand how this works in practice. So there we go. So this is all represented as a share of GDP. And so what this basically means it kind of has to add up. So here we have the dotted gray line. Those are households. And obviously it's in positive territory, so it's above the zero. So again, this represents an economy where households are saving quite a substantial amount. So 10% of GDP is pretty good. Then you have the dark black line, non-financial corporations. Again, this does not include the financial sector, because the financial sector is an intermediary of this. So we can forget that it exists for a moment. So non-financial corporations are in negative territory because, as I explained, they are net investors. Then we have, they have a separate line for financial institutions. But again, let's just forget about this for a bit. Then we have the thin black line, which is the rest of the world. Now, you'll notice that it's in negative territory. Again, you have to see this not as the current account balance, but rather the inverse of the current account balance to represent whether you're a net lender or a net borrower. So if you're running a current account surplus, this is going to appear negative in this interpretation, right? Because you're lending abroad. Remember that Japan has typically run current account surpluses. It's a country that exports much more than it imports. So that's why you'll see it. If it was the US, you would have this line in positive territory because the US tends to be a net borrower from the world. What else? And then we have the dashed gray line, which is government. So let's look at this chart up until around 1990. So this was the boom years of the 80s. And this looks incredibly healthy. If you showed this chart to any economist and you ask them, like, what do you think of this economy? Is it healthy? They would unequivocally say yes. Households are saving. Corporations are investing. a massive amount. I mean, look at that investment, that net investment. Remember, this is net investment. Around 89, 90. It's massive. So this is incredible. This is a sign of a very healthy corporate sector that's investing. You are also running a fiscal surplus, which again is a sign of a very healthy economy. And you are running a current account surplus as well. So you're exporting more than you're importing. Like Japan is getting it all right by looking at this chart. If you compare Japan with the US, you would definitely think Japan is the healthier economy of the two at this point in time. But what was hidden in this? What couldn't you see in this analysis? Well, a massive asset bubble. So at the time, the Japanese stock market was through the roof, and it was a bubble. It was far in excess of the real value of many companies. Remember, this was a time. And there was also a real estate bubble, mostly a corporate real estate bubble. This was a time when Japan was buying, you know, land anywhere in the world because they had so much money because the stock prices were so inflated. They had so much cash. If you were alive back then in the 80s, you had this idea of Japan just being an economic superpower that was possibly even going to overtake the US at some point. There was even, I remember there was a quote somewhere of like, the land under the Imperial Palace in Tokyo was worth more than the entire state of California. So that's how big the bubble was. Then in 1990, the stock market burst. And with it, the entire bubble. And what happened there? Well, corporations were basically left with massive holes in their balance sheets. Absolutely massive, because they had, these are you leverage money based on assets that you own, that you believe are of a certain price. And then if you're told, hey, guess what? Actually, that land, all those land holdings are actually worth, half or less than what you thought they were. Same as with your stock price. So corporations just had a massive hole blown into their finances. So the obvious consequence of this is that there is no way on earth that you're going to maintain the same level of net investment as you did before the bubble burst. So that is exactly what you're seeing after 1990, when that dark black line starts swinging perilously towards zero. And then at some point in the late 90s, it actually becomes positive. So at the peak of this, which was around 2002-ish, look at the level of net investment, or rather net saving from Japanese companies. It was close to 10% of GDP. This is insane. This is absolutely insane. So what they're basically doing here is they're basically saving as much money as they can to make up for those holes in their finances and not investing. And you can see a chart here of, this is gross fixed capital formation of Japan. And you can see how it just starts going down after the 90s. And it was really, really incredible how much they were investing. Most economies today spend about 20 to 25% of their GDP in gross fixed investment. Japan was well in the 30s territory. So, and then this just slumped, hasn't recovered since. So that is basically how this has been reflected in terms of the gross. Remember, gross is just what they're investing. Here we're looking at the net. So they're saving a lot of money to make up for those, the asset bubble bursting. Now, what happens here? So at this point, if you look at it from an external perspective, nothing changes because Japanese products have remained competitive. It's still an exporting powerhouse. So let's forget the rest of the world exists because nothing really changed there. Households, at least during the beginning of the 90s, were still, savings started to fall, actually quite substantially, but then fell even more into the 2000s. So what happens now? You have less household savings. You have less net investment from the corporate sector. Who's going to plug that hole? And the answer is government. There was no other way. So government, if you look at here, they ended the 80s with a surplus. Government starts, the net saving of the government starts turning into a deficit. And that is for various reasons. So they immediately after the asset bubble, Japan launched a number of stimulus programs. But at some point, they also, I think it was in 2001, they also started engaging in quantitative easing. But overall, this basically reflects a situation in which these components have to add up to zero. And so if all the other sectors are moving in a certain direction, one of them has to net them all out. And the sector that ended up netting the changes in the corporate sector and household sector as well was government. So there was no other way. And I'm mentioning Japan because Japan is a country in the world with the highest level of debt. Japan's debt is something like 200, close to 300. Maybe it's I didn't check the figure before actually we can check the figure here. What is Japan's debt? Where is it? Debt stock. External. Oh, that's just external. Never mind. It's around 300% of GDP. So it's absolutely massive. Most Western countries have a bit of a freak out when they start exceeding 60% of GDP or when they start approaching 100% of GDP. Japan's is off the scale. And has Japan suffered a fiscal crisis? No. Has Japan suffered rampant inflation? Quite the contrary. Their main problem with inflation has been deflation. Have Japanese interest rates gone through the roof? No, they're among the lowest of any developed country. So the idea here, a lot of people use Japan as an example of this is proof that MMT works. Because this is a country that basically ran massive deficits, and I insist, because it had to. And that's kind of the conclusion of the book, The Holy Grail of Macroeconomics. Japan had no other choice but to run those deficits because of the behavior of these other sectors. Now, this is not entirely true, that Japan basically is an example of MMT working, because the way in which Japan spent that money, those government deficits ended up being spent on, is not really the way that MMT advocates would want that money to be spent. So MMT argues that those deficits should be used to generate any kind of spending that promotes employment. So the idea is to use fiscal spending to target full employment. And the main way to do this would be through a jobs guarantee. Now, the jobs guarantee is not unique to MMT. It has been proposed by usually left-wing politicians. I believe Corbyn and Bernie supported something along those lines. So again, this is not unique to MMT, and there is a fundamental difference of various things here. First, there is the distinction of whether printing money generates inflation, which is one of the concerns of people who especially who criticize MMT. The answer, of course, is no, and I proved it in the previous video. Printing money in itself does not generate inflation. What generates inflation is what you spend that money that you just printed on. So if you do something like quantitative easing, which is basically just buying assets from banks and giving them money. So you print the money and use that money to buy assets that the banks have. That in itself doesn't generate inflation because that money isn't necessarily spent. In fact, the main criticism of quantitative easing is that banks didn't do much with that money. They didn't lend it out. So if the banks had lent all that money out to consumers and businesses, then you may have had inflation if the economy had recovered close to its level, its peak resource utilization. But as it is, QE in itself does not generate any form of just printing money and giving it to banks does not necessarily generate inflation. So this type of the other distinction is, what are you spending this money on? So what is this government spending being used on? Is it a direct stimulus? Like, is the government giving money to people who then spend that money? Again, you can maybe make that claim that it would be necessarily inflationary, but that's not always the case. So, or if you spend it, for example, in infrastructure, things like that, this is all still very questionable. Now, Japan didn't do that, and that's the fundamental problem. In fact, Japan during the 90s, their stimulus and their deficits were very targeted at just like the moment that they were kind of afraid of deflation. And I have a chart here of inflation in Japan. So you can see that from the 90s onward, they have various spells. 1995, it was slightly below the line. You had a spell of deflation in the early 90s and beginning of the 2000s. So that was really what terrified. And then you had another one in 2009. This was caused by the financial crisis, obviously. So this is really what terrified Japanese economists at the time: deflation. They were afraid that the country was going to go into a deflationary spiral, which would have ended up worsening their economic situation. Now, remember, this and this is kind of the point that I'm making, that even though the spending itself was probably not the best way in which they could have done it, they could have invested more in infrastructure. They could have invested more in their welfare state. Japan actually has a very, very weak by European standard. It's better than the U.S. obviously, but compared to what most European countries, social spending in Japan is very low. So there were many other ways. It was not a very proactive way of using fiscal policy. That is kind of what I'm getting at. And you had reason to believe that had they done a more proactive type of fiscal policy of the type that MMT advocates would have promoted, then you would have been able to escape that crisis. I'm not going to call it a recession, because Japan actually didn't really have, if you look at the GDP numbers, and this is why this worked in a sense. So it may have been mistargeted. The fiscal spending may have been mistargeted, but actually these deficits, this skyrocketing debt, served one very, very, very important purpose, and that is Japanese people did not lose their living standards during this entire period of a lost decade or two. And you can look at it at the GDP per capita numbers. If you look at this, from 1990 onward to the Great Recession, well, the global financial crisis, the Western Great Recession, GDP per capita actually rose. Not as much as it did during the boom years of the 80s, but it did rise. And this is absolutely, this is incredibly positive, and something that countries that typically have lost decades don't benefit from. Latin America, Mexico's lost decades. We did not see this. Okay, so something worked. And I will also mention it now. If you're ever looking at Japan, please, 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 because I see this from so many otherwise, professional economists who always do this. And it is a first sign, like it's the first red flag that you don't know Japan well enough. Never, ever look at Japan's headline GDP number. Why? Because it's a country whose population is declining. So look at the GDP per capita numbers. And actually, if you compare this with a lot of Western, if you just look at the GDP numbers, you're going to say, well, Japan has never left its recession. But yeah, because its population is declining. If you compare the GDP per capita numbers, they're actually not any way worse than most other Western countries. So Japan has doing okay. You can see countless commentaries of people going to Japan and like, wait, and they see, Tokyo's booming, and there's life in the streets that people are buying. And they're like, wait, this is a country that's in a crisis? The answer is, it isn't. That's not to say that this has been a very a very traumatic structural experience for the Japanese economy. You know, the price of maintaining the living standards of the average Japanese person has been to see its GDP rise from, I think it was like 50% of GDP in the 80s to close to 300% of GDP. So that is pretty impressive. Again, this could have been better. This could have been better if the type of fiscal spending had been targeted correctly. So yeah, now again, sort of putting this into the MMT debate. There's the part here that is very tricky, and it's something that I haven't honestly done enough research to give an answer, is kind of like a chicken and an egg thing. So which sectors respond to decisions in others? We would like to think that the government, by the way that it uses public resources, will influence the behavior of the other sectors. But how do we know this is true? And the answer is, well, we kind of don't. So one of the if you and I mentioned it, I'm going to repeat this from the previous video, but one of the common ways of looking at, for example, monetary policy is this idea that the central bank sets interest rates, and those interest rates subsequently determine the levels of investment, because companies will not invest if interest rates are too high, because their rate of return may not, the risk reward ratio might not justify those investments. But as it turns out, there is enough evidence, and again, I'm gonna repeat this paper published by the Federal Reserve, that shows that actually business decisions aren't that sensitive to interest rates. And if you think of a situation like now, over the past couple of like the last decade, companies, especially the big ones, have been awash with cash. They have so much cash, they don't even know what to do with them, and they're not investing. So all these factors influence how companies decide to invest or not invest, not just the interest rate. And this study showed that, in fact, the majority of businesses were pretty insensitive to changes in interest rates. Now, the other thing that is very criticizable of the standard way that we look at things is, for example, because household savings are what eventually gets deposited into banks, and then the banks give away these loans. There's a direct relationship between household spending and what companies decide to invest. And then the answer is, well, not really. Again, I mentioned it in the previous video, but this was a very mind-blowing paper that was published by the Bank of England in 2014 that basically just destroyed the standard textbook explanation of how money is created. And this is the way, if you read any economics textbook, the explanation is that households save money, they deposit it in a bank, and then the bank lends money on the basis of the reserve requirements that are set by the central bank. So the central bank influences money creation by setting those reserve requirements. But in reality, what this paper shows is that no, actually, banks determine how much money is created by loaning. So the chicken and the egg here is that the loans come first. And if that is true, then, if that is true, then what happened here, this line government, was to some extent inevitable. Because this decision to net save by the Japanese corporate sector was fundamentally unavoidable by any kind of monetary policy that the government of Japan could have done, or rather the Bank of Japan could have undertaken. So really, the only way to have maintained an economy that didn't collapse. And look at this, like just look at how much this changed. An equivalent of like 20% of GDP was lost by this decision by Japanese companies to become net savers, because their investment level was 10%, around 10% of GDP. And then their savings went up to almost 10% of GDP. So that was a difference of almost 20% of GDP. That's how big the contraction of Japan's economy would have been if the government hadn't stepped in. So look at it that way. The Japanese economy would have lost 1/5 of its GDP if this fiscal spending had not taken place, even if it was bad fiscal spending. So how do we reconcile all of this with MMT? The answer is, again, I haven't done enough research to give an answer, but my way of thinking about what they intend, or what MMT advocates are really kind of driving for, is that a situation like this, maybe not this extreme, but a situation in which you have a permanent level of government deficits, will obviously not harm the economy. And if the investment is targeted in job creation type policies, like a jobs guarantee or something of the sort, then all the typical the standard economic theory of all the problems that will arise from this will just not happen. And again, the Japanese case here is to illustrate that in fact many of them did not happen. The rise in interest rates did not happen. Inflation did not happen. So I don't know. My issue here is all of this can really be like, none of what I just explained is unique to MMT. So I don't see why we need a new theory to kind of understand things that already have some empirical basis and that have been applied to some extent in different situations. So that is sort of my criticism. Like why do we actually need MMT? Like we already have evidence that some of these politics works without a kind of MMT framework. There's other stuff that I mentioned in the previous video that I'm not going to get into. But I hope this was sort of interesting to you all in understanding how an economy works through this sectoral balances approach that isn't your typical like GDP up or GDP down analysis. And like I said, Japan is a very, very interesting country. It was in some ways a test bed for many policies that were subsequently applied after the global financial crisis, things like quantitative easing. Japan did that first. They were the pioneers of this policy. So the jury's still out whether Japan did the right thing or not. I think that as a whole, the policy of the fiscal spending bit was, as I've shown you, inevitable, absolutely inevitable. There was no other way that they could have avoided a depression, not a recession, a depression, if the government hadn't stepped in and plugged in this hole in the sectoral balances that the corporate sector left. But again, this all could have probably been shortened if they had used fiscal policy more effectively, if they had done programs that were better targeted for growth, which they didn't do. So if this situation repeats itself, I hope that is the lesson. But the lesson is not that Japan's government spent too much or spent irresponsibly, because that's clearly not the case. And libertarians will look at this chart and sort of have a mini stroke, but I dare them to present an alternative. That I would love for them, anyone, to present to me an alternative history in which Japan did not indebt itself the way that it did and avoided a depression. I would really love to know what the strategy would have been like. But yeah, on that note, I hope you like this video. I hope it gets you interested in economics a bit. And I hope if you are interested in economics a bit, I hope this opened up a different avenue in which you can do your own research on things. And like I said, MMT and the sectoral balances approach are very related to each other. You will see a lot of it in the discussions of MMT, and you will see very little of it in the criticism of MMT, which is, again, I think is the criticism is very disingenuous in many respects, even though, like, I'll say it for the umpteenth time, I'm still not 100% convinced of MMT as a sort of unified theory of how fiscal and monetary policy worked, but I'll keep reading and I'll make up my mind eventually. So, on that note, if you like this video, please like, please share. Most importantly, please subscribe to the channel. And I'll see you next time.